What's one of the main reasons why businesses fail? Poor cash flow. So in this video, I'm going to run through the importance of treating our family unit just like a business. You Pty Ltd. Hi, my name's Tim, and for many years I've been working with property investors to acquire, maybe it's their first investment property, could even be just adding to their existing portfolio. One of the things that we focus on, and certainly was something that really helped me in my early stages of becoming a property investor and a business owner, was focusing on how profitable we are. And the reason for that, or the main reason for that, is that we need to establish what our surplus cash flow looks like. So like any business, we're going to have income and expenses. So at the end of the day, once we take the expenses away from our net income, that will then determine how much we have surplus in cash flow. Now, from there, as directors of our business, family business, we can then decide on how much of that surplus cash flow we allocate or dedicate to property investment in this example. Now, just like a business owner, I'll often parts of, or a component of, percentage of the profits will go back into building the business. So it will be sent back through to improve the business. So we can do exactly the same with our family unit. And again, most Australians look to acquire property as a wealth creation strategy. So what we want to make sure that we do, though, prior to acquiring an investment property, is find out how much of that surplus we have that we can then use and set aside to supporting an investment property. Now, we're at the end of 2021. Interest rates have been the lowest they have ever for some time now, so it's quite easy to find a property that if it isn't in a positive cash flow position, it certainly wouldn't be costing a lot to hold that property. So what we need to make sure that we do is that we also take into consideration, well, if there's going to be an interest rate rise, what does that look like as far as our expenses increasing? And obviously the repayments on a loan make up the majority of the expense of owning an investment property. So once we know what that looks like, then we can say, well, okay, then if I'm going to acquire this property, if I work it back to my surplus, then, and I know what numbers I'm looking at, and I can know then whether or not I should be buying this investment property, it's not going to put us into financial hardship. So just like the cash flow surplus, the other component that we need to consider is the capital we have. So the capital we use for acquiring property in the sense it'll be to fund deposits and also purchase costs. Now, typically the capital will be sourced from two main areas. One will be equity within property that we own, be it owner-occupied property, it could even be an investment property or properties, and the other will be cash. So we can either use a combination, we can use one or the other, or a combination of those two things. Now, what we need to do, just like we did with the surplus cash flow, is then say, okay, well, this is the capital we have available. What percentage of that are we going to dedicate to property investment? And then we also want to do that. Once we establish that, then we can also, in both cases again, have buffers created. So cash flow buffers and capital buffers. And they can both be in the form of personal use as well as investment use, and we keep those two things separate. Now, by doing that, that allows us to then leverage using other people's money, so finance, and the capital, the equity that we have also too in our property, and all the cash. So we can then leverage those components into investing in property, which if done the right way, obviously will increase our net worth. So just like a business builds, we build the net worth of our family unit. And it's important, though, to be able to see out that journey and then get the reward for maintaining and sustaining that portfolio. We need to make sure that that cash flow position of that property, those income producing assets, aren't going to push us into hardship. We need to know that if something was to happen, we may not be able to factor that in. We can factor some things in. Some things are out of our control. If there's an unexpected expense, we need to make sure that it's not going to drown us. It's not going to force us into selling an investment property. So those two things are very important. So surplus cash flow and available capital. Now, from there, we also need to consider our risk profile. So if you're investing on your own, that's okay. You can understand what that looks like. If you're investing with somebody else, you need to have that discussion, and you probably get an idea if you've been around together long enough. You understand sort of your approach to each other's approach to risk. So what that needs to look like from an investment point of view is that, so we look at it in three categories: conservative, balanced, and assertive. Now, if two people are investing together and one's got a conservative profile, the other's got an assertive profile, you're probably going to have to compromise a little bit. The other thing we need to make sure is that if we look at our financial position and it's determined that we've got very, very strong income, so our serviceability is very strong, and we've got ample amount of capital. So effectively, we could, if we wanted to, go out and invest in multiple properties quickly. Now, if we've got a conservative profile, then that's not congruent. With that action doesn't meet and match with that risk profile. So we need to take that in consideration as well. So you need to determine what that looks like, just for your understanding your rates of property acquisition and your comfortability around acquiring debt, because most people fear or their concerns are the debt level that they will get into when they're acquiring property and building a portfolio. So the risk profiles are important as well, and that can give us a very good understanding of what that journey is going to look like and how long it's going to take us to get there. The other thing that it will help us with is determining our investment strategy. And equally, if we've got a conservative profile and someone starts talking to us about property development, then probably that's not going to fit either, because property development is a higher risk strategy. Sure, it's a higher reward, but there's a lot more moving parts to property development than there is to, say, a buy and hold strategy. So again, if you've got a conservative profile and you don't have a lot of investment experience, then jumping straight into a development project is, again, not really matching your risk profile. So those things are really important, and the profile is important. Again, making sure that we feel comfortable with what's happening, because the last thing you want to do is start acquiring property and then have some sort of headbutting or arguments around what that should look like, because we need to be happy and feel comfortable in that journey, both from a cash flow point of view, but also too that we're doing the right thing together, or I'm doing the right thing on my own as far as that journey. And the last one I want to cover off is leverage. So as investors, leverage is gold, really. Now, we can leverage other people's money, being a lender, so we don't have to, if we're going to go out and acquire an investment property, we don't have to have all the capital to cover the full cost of that property. We can go to a lender and borrow money to assist with that purchase. And then the other one is other people's experience. So we don't have to do it on our own. Some things we can't. You may not be qualified to do that. Obviously, for as a solicitor or an accountant, whatever that may be. So the importance of leveraging into or delegating tasks and leveraging other people's experience. Some of those people who form your wealth creation team will help you acquire the property. Others will also help you maintain and sustain that portfolio. Some you'll use more often than others, and your wealth creation team may look different than the person next door. So it's going to mean different things to different people. But really using that advantage of leverage is something that is huge. It's a massive advantage to us as investors. Otherwise, you can just imagine trying to save up enough money, capital, to then invest in a property outright. Probably wouldn't be too many people who could invest. So you can build a very, very healthy portfolio using other people's money and other people's experience. Alrighty, so you Proprietary Limited, determine what your surplus is, cash flow surplus is. From there, you can calculate or work out how much or what percentage portion of that surplus you're willing to or happy to allocate towards property investment. Same with the capital. Establish your capital base, and then work out also to a percentage of that capital that you want to preserve. And then from there, again, working through your risk profiles, making sure that you're not doing something that, one, you're not experienced with, doesn't work with your risk profile, and it may not even work. So again, we'll use that example of property development. If you're time poor and you're looking to project manage, then that's going to be very, very difficult. So all those things need to work in together to give you that very good chance of seeing out the journey, getting to the end, and then being rewarded for being able to stick to that journey and that process with the capital gains that you'll make by seeing out again that time frame. So work with buffers. Don't put all your cash, all your capital into any one deal. Make sure you preserve some of those things. There will be things that will come up that you won't expect. You don't want those things to derail your journey. The last thing you want to be doing is selling property because you can't afford it. Time in the market is huge, and so therefore you want to give yourself every chance possible of seeing out that journey. Okay, well, I hope you found that information helpful and interesting. If you're happy to give the video a like, that'd be sensational. And equally, if you haven't already subscribed to my channel, please feel free to do that. That would be fantastic. And look, once again, thank you so much for sparing the time to watch the video. And whatever you choose to do, I wish you all the best with your journey. Thanks so much.